Silver is being pulled from the market so quietly and so consistently that the last decade of normal price action is starting to look like a different era. Not because of hype, not because of social media noise, because two demand engines that usually take turns, industrial demand and monetary demand, are now accelerating at the same time. When that happens in a market with limited supply flexibility, price doesn't negotiate gently, it rebalances hard. Start with a simple contradiction that should make anyone pay attention. Silver is priced like it's plentiful, yet it's being consumed like it's scarce. That gap between perception and reality can persist for a while, and then it can close suddenly. One day the market looks calm, the next day the bids get frantic, and the only thing that clears the imbalance is a higher price. Here's the data point that frames the whole conversation. 16 billion ounces, 7 million ounces, 9 million ounces. Add those supply streams together and it becomes obvious why deficits have become a recurring theme rather than a one-off anomaly. And deficits matter because deficits are not an opinion, they're math. If demand is persistently higher than supply, the difference is covered by drawing down above-ground inventories. That inventory draw is the silent story most people miss until the silence breaks. Now, connect the dots with the structure of silver itself. Silver isn't just a precious metal. It's also a critical industrial input. That alone makes it unusual. Gold can sit in vaults for decades and nothing breaks. Silver can't. Silver is used up. It's embedded into products. It gets dispersed across millions of devices and components where it's uneconomical to recover. In other words, a meaningful portion of silver demand is not investment demand that can reverse overnight. It's consumption demand that is tied to production lines and national priorities. That's why the industrial channel matters so much right now. Silver is the most electrically conductive metal on Earth. It has outstanding thermal conductivity. It's highly reflective. It has antimicrobial properties. Those aren't trivia facts. Those are reasons silver shows up in photovoltaics, electronics, grid infrastructure, medical applications, water purification, chemical catalysts, automotive systems, and defense technologies. And the more the world electrifies, digitizes, and hardens infrastructure against geopolitical risk, the more silver demand becomes structural instead of cyclical. Solar is a clean example because it's measurable and it's scaling. Photovoltaics need silver for the contacts that move electrons efficiently. Over the last decade, manufacturers have worked hard to reduce silver loading per panel. That process is called thrifting, using less silver per unit of output. But here's the catch. Even if each panel uses less silver, total silver demand can still rise if the number of panels installed grows faster than the thrift rate. That is exactly what's been happening. Solar deployment has expanded so quickly that aggregate silver demand from PV has remained a major and growing draw on physical supply, year after year. Electronics add another layer. Every device that needs reliable, high-conductivity connections, especially in high-performance applications, ends up using silver in critical points. And now the AI build-out is amplifying that. AI isn't just software. It's racks of GPUs, data centers, power management systems, cooling infrastructure, and upgraded grid capacity. The Silver Institute has noted that demand also received a boost from AI-related applications. It means the physical infrastructure that makes AI possible is silver-intensive. Let that sink in. A digital boom can drive a physical commodity. Then there's the automotive channel. Electric vehicles and hybrid systems require more electrical connectivity and more complex power. Electronics then internal combustion systems. Charging infrastructure pulls forward grid upgrades. Grid upgrades require switchgear, connectors, and high-reliability components, many of which use silver. The point is not that silver demand relies on one trend. The point is that multiple trends are stacking. Now, zoom out into geopolitics, because this is where the industrial and monetary channels begin to overlap. The world has been moving from a low-friction globalization era into a high-friction fragmentation era. Supply chains are being regionalized. Strategic stockpiles matter again. Defense budgets have climbed $718 trillion. In 2024, a record level. Defense spending is not a perfect proxy for silver demand, but it signals something real. More procurement, more electronics, more secure communications, more aerospace systems, more missile guidance, more surveillance and counter-surveillance, all of which rely on high reliability components where silver is difficult to replace without sacrificing performance. This is the part that ties it together. When industrial demand rises during geopolitical stress, monetary demand often rises too. Because geopolitical stress doesn't just affect factories. It affects confidence. It affects trade flows. It affects currency stability. It affects trust in financial plumbing. And silver has a second identity. It's money in metal form. Not in the modern legal tender sense, but in the historical and psychological sense that matters. When people look for assets outside the promise of a counterparty. Monetary demand in silver shows up in physical bars and coins, and it shows up in strategic long-term holdings. It's also shaped by affordability. Gold is the institutional monetary metal. Central banks buy gold. Silver is often the people's monetary metal because it's more accessible per ounce and can be accumulated gradually. In periods where inflation shocks, currency volatility, or debt concerns rise, silver tends to attract a different kind of buyer, one who cares less about quarterly returns and more about long-term resilience. Now, to understand why this can get explosive, it helps to understand how silver is priced. Spot prices are heavily influenced by futures trading on exchanges like COMEX in New York and the broader wholesale bullion ecosystem in London. Futures contracts represent promises to deliver metal at a future date. Most contracts are closed out or rolled over. Only a small percentage results in physical delivery. That's not automatically a problem. It becomes a problem when the paper market grows large relative to the readily deliverable physical inventory. This is where technical vocabulary matters, so define it clearly. In COMEX warehouse reporting, eligible silver meets exchange standards but is not committed for delivery. Registered silver is deliverable, metal that has been placed under warrant and is available to satisfy delivery demands. Eligible can become registered, but only if the owner chooses. That means registered inventory is a more direct measure of what's immediately available to meet delivery pressure. When registered inventories shrink, the system has less buffer. And backwardation happens when near-term prices are higher than longer-dated futures. In precious metals, persistent backwardation is unusual because storage and financing costs normally create a slight premium for future delivery, a structure known as contango. Backwardation can appear in flashes and disappear quickly, but when it shows up repeatedly, it's a signal that physical tightness is tugging against the paper curve. And then there are premiums, the real-world price people actually pay for physical silver. Spot is the reference price. Physical premiums are the markup for fabrication, distribution, and scarcity. When physical availability tightens, premiums can rise even if spot doesn't move much. That divergence is one of the first cracks in the everything is fine narrative. It suggests that the paper price is not fully reflecting the cost of securing metal in hand. Now bring in the deficit story with more specificity, because this is where structural thesis becomes hard data. Metals Focus and the Silver Institute have described consecutive annual deficits in the silver market. 3 million ounces in 2023. That is not a rounding error. That is a persistent drawdown. Over multiple years, deficits compound into meaningful inventory depletion. If deficits persist, the market becomes more sensitive to shocks, because less above-ground stock is available to absorb sudden demand spikes. Ask a simple question. If a market runs deficits year after year, where does the metal come from? The answer is inventories, stockpiles held in exchanges, ETFs, industrial supply chains, private vaults, and government reserves where they exist. Some of those pools are sticky. Some are strategic, some are price sensitive, but none are infinite. When the easy inventory has been used, the remaining inventory becomes reluctant inventory. And reluctant inventory demands a higher price to move. This is why silver is different from many other commodities. In oil, higher prices can incentivize drilling. In copper, higher prices can accelerate project financing. In silver, supply response is constrained because much of silver production is a byproduct of mining for other metals. If a miner is primarily producing copper or zinc, silver output depends on the economics of that primary metal, not on silver alone. That makes silver supply inelastic. Higher silver prices help, but they don't instantly unlock a wave of new mine supply the way people assume. New mines take years. Permitting takes years. Capital takes years. And byproduct dynamics do not bend quickly. Recycling helps at the margin, and the numbers show it. 9 million ounces in 2024, a 12-year high. That's meaningful. But it's not enough to erase a structural imbalance when total demand is running above 1 billion ounces. Recycling is a pressure valve, not a replacement for mine supply. And some silver is simply lost to dispersion, used in ways that don't come back into the recycling stream efficiently. Now shift into the chart layer, because price structure tells a story of its own. Silver has spent years oscillating in a broad range, repeatedly failing to hold above key resistance zones. The area around the high 20s and into the low 30s has historically acted like a ceiling. That ceiling matters because it's where prior rallies have been sold down, often aggressively. But here's what changes when fundamentals tighten. The more times a level is tested, the more significant a break can become, because the market is spending time absorbing supply that used to overwhelm demand. Technical indicators often confirm this tension before it resolves. A rising long-term moving average suggests trend pressure building. Stronger pullbacks that hold above prior support zones suggest accumulation. Momentum oscillators like RSI can show whether buyers are losing steam or whether strength is building without going parabolic. Technical analysis doesn't predict the future. It maps where traders are likely to react. In a fundamentally tightening market, those reaction zones can turn from ceilings into launch points. But the bearish case deserves real oxygen, because silver can punish impatience. A global recession can temporarily reduce industrial consumption. A sharply stronger US dollar can pressure precious metals. Interest rate spikes can tighten financial conditions and trigger deleveraging across markets, including commodities. And silver's futures market is notorious for volatility amplified by leverage, margin changes, and fast-moving liquidity conditions. Another bearish factor is substitution and thrifting. In solar, manufacturers have pushed hard to reduce silver per panel, and some technologies attempt to replace silver with copper plating or other materials. That effort is real. It can slow demand growth at the margin, but it has limits. Substitution must meet performance, reliability, and manufacturing yield requirements at scale. When substitution introduces failure risk or production complexity, adoption can be slower than headlines imply. Even when thrifting succeeds, it can be overwhelmed by the scale of deployment, especially if global energy transition targets remain aggressive. There's also the uncomfortable reality of market structure. Paper markets can remain dominant for longer than fundamentals suggest because pricing is set at the margin by futures trading volume. Price discovery can be noisy, it can be distorted by positioning, it can swing based on macro headlines that have nothing to do with physical availability. That's why silver can look wrong for longer than expected, and then correct violently. The path matters for risk management, even if the destination is higher. So what keeps the bullish thesis intact, even with those risks on the table? The answer is convergence. Industrial demand is not a single trend, it's a stack of trends. Solar, electrification, grid upgrades, electronics, AI infrastructure, defense procurement, medical applications, all pulling in the same direction. Monetary demand is not a single emotion. It's a response to long-term debt expansion, currency risk, and trust dynamics that don't reset overnight. Supply is constrained by geology, capital cycles, and byproduct realities. When those three conditions align, rising demand, constrained supply, shrinking buffers, the market becomes more sensitive to shocks, and the risk profile tilts. This is not the kind of setup that requires everyone to agree. It only requires the marginal buyer to show up when inventory buffers are thin. It only requires one segment, a manufacturer securing supply, an investor hedging currency risk, a supply chain manager reducing exposure to delivery uncertainty, to decide that metal in hand is worth paying up for. That's how tight markets move. Quietly at first, then suddenly. And it's worth emphasizing that silver's dual role can create feedback loops. When industrial demand tightens supply, premiums rise, and delivery lead times extend, the metal starts behaving more like a scarcity asset. That scarcity perception can pull in monetary demand. When monetary demand pulls metal off the market, industrial buyers have to bid more aggressively to secure supply. That can lift prices, which draws attention, which attracts more capital. Feedback loops are not guaranteed, but silver is one of the few markets where the ingredients exist. Now translate this into implications. Without hype and without pretending certainty exists, physical silver holders tend to care about long-term purchasing power and systemic hedging. In that context, the key variable is not the spot price tomorrow. It's whether physical tightness and deficits persist over years. Traders care about volatility and timing, and silver offers both, but only with strict risk controls. For anyone new, the most important move is not to chase headlines. It's to follow the data, track annual supply and demand from the Silver Institute, watch mine production trends and recycling trends, observe reported deficits and inventory draws, monitor physical premiums and delivery lead times, learn what registered versus eligible inventories mean. Learn how backwardation appears and what it suggests. The goal is not to predict today, the goal is to understand a structure. Verification is straightforward. The Silver Institute and Metals Focus publish detailed annual surveys and summaries. Exchanges publish delivery and stock reports. Energy agencies publish solar installation trends. Defense spending data is tracked by institutions like CyPrE. None of this requires belief. It requires attention. This is where conventional wisdom often gets it wrong. People debate silver with opinions instead of checking the plumbing. Now, pull the thread all the way to the core message. Silver demand is no longer a single narrative. It is industrial necessity plus monetary interest at the same time. 16 billion ounces in 2024, 7 million ounces, 9 million ounces, 3 million ounces in 2023. These are not small numbers. They represent the kind of structural pressure that slowly drains the buffer and eventually forces repricing. Risk still exists. Volatility is part of the deal. Price can drop sharply. Macro conditions can shift. Futures positioning can unwind. Policy responses can surprise. No outcome is guaranteed. Any exposure should be sized with humility and managed with discipline. This is educational information, not financial advice. There are no promises here, only probabilities, structures, and observable data. But the structure is the point. When a market runs repeated deficits, when supply is slow to respond, when industrial consumption is embedded into global infrastructure, and when monetary demand increases during uncertainty, the balance of risks changes. The market becomes less forgiving, it becomes more sensitive, and it becomes more likely that price will eventually do what price always does in a tight market. It will ration demand by moving higher. Silver already matters. It matters in factories, it matters in grids, it matters in defense systems, it matters in the psychology of savings. And when industrial demand and monetary demand pull in the same direction, with shrinking buffers, the question is no longer whether the market notices. The question is when, and whether the repricing happens slowly or all at once.